Good evening. I would like to take a brief moment to review highlights from Wright-Hennepin's 2013 financial statements. The board and management believe your financial condition continues to be very strong. And tonight we are privileged to have one of our bankers here to also give his perspective of your cooperative's financial performance. Let's get started with the December 31st, 2013 balance sheet. If you'd like to follow along, please refer to page 6, the top of page 6. Page 6 in your program. Line 3, total utility plan assets, 2013, ending balance of $158 million. Net growth over 2012 was $7 million. This line reflects our commitment to responsibly invest in construction and maintenance of the electric grid to make sure we provide you reliable service. Line 10, other property and investments, $42.6 million. The vast majority of this, almost $37 million, represents Wright-Hennepin's share of our wholesale power suppliers' patronage allocations, which in turn have been allocated to you in the form of capital credits. As we have been reporting to you, Great River Energy has been deferring the retirement of capital credits since 1998 due to the significant build-out of new generation and transmission lines such as those you see along the freeway from St. Cloud to Monticello, as well as to be in compliance with the many new environmental mandates that are coming out of the EPA. Once these unusually large capital expenses are complete, GRE expects to start returning capital credits again. We expect that to be several more years. Also on this line, line 10, includes the diversified businesses your cooperative owns and patronage allocations from our lenders. Line 11, cash and cash equivalents, almost $18 million. This is an exceptionally strong cash position. In 2013, we took advantage of very low interest rates, around 3%, to assure affordable funding for future planned construction to keep Wright-Hennepin's system reliable for you. Line 18, deferred debits, $8.6 million. In 2011, your board made the decision to terminate the legacy defined benefit pension plan offered through our National Trade Association. After in-depth research and analysis, it was determined that the cost increases to this program were unsustainable for the future if we are to continue meeting our goal of competitive electric rates for the membership. As we exit the long-time pension plan for a lower cost alternative, the plan value needs to temporarily sit on the balance sheet, and that value will fluctuate with the market. Once the plan is terminated, the additional dollars will no longer be reflected on the statements. This is a very good move to help control costs and keep your electric rates competitive for the long-term future. That brings us to line 19. Total assets, December 31st, 2013, the book value of your business, $191,641,156. Line 22, members' equity, $77.5 million. The majority of it is allocated to you, the member, as it should be in the cooperative business model. Line 27, long-term debt, $83.8 million, which is Wright-Hennepin's mortgage on the $158 million investment in poles, wire, meters, transformers, substations, etc. We are pleased to say that we have the majority of our debt borrowed long-term versus short-term or variable, and at a very favorable blended rate of just 3.98%. Line 33, current and other liabilities, $27 million. Other liabilities are lower than 2012, primarily due to the normal fluctuation in the value of the pension plan based on market conditions. Line 35, total members' equity and liabilities equaling total assets, $191,641,156. Moving on to the 2013 Statement of Operations found on the bottom of page 6 in your program, the bottom of page 6. Line 51, operating revenues, $92 million. Line 52, cost of wholesale power, Wright-Hennepin's single largest expense, 70% of revenues, $64 million. Our local operating costs found on line 56 continue to be among the very lowest in the nation, And our banker, Mike Bunny, will visit more with you about the significance of this in just a bit. You will notice an increase to this line, line 56, on the operating statement, but that was primarily due to the acceleration of some one-time expenses taken in 2013 to offset your future rates. Had we not accelerated these expenses, the local operating expenses for 2013 would have been very similar to 2012. Taking these charges early equates to continued competitive rates for you into the future. Line 60, fixed charges, $10.2 million, comprised of property taxes, depreciation, and interest. 2013 fixed charges are very similar to 2012. That leaves us with a margin from electric operations of $2.7 million found on line 61. These were greater margins than we forecasted, resulting primarily from weather-driven sales, lower wholesale power costs resulting from our load management programs, and best-in-class managed local operating costs. Line 62, Conservation Improvement Program, $550,000. This is mandated spending by the state for energy conservation programs. Line 63, non-operating margins, a loss of $181,384. This line includes interest income as well as profits from the diversified businesses. This line was profitable before we booked a one-time non-cash adjustment for one of our research and development projects, an investment in Silent Power of Baxter, Minnesota. Silent Power is a manufacturer of battery storage units for renewable energy applications. This investment was a major part of our strategy to bring renewable energy into the mainstream for Wright-Hennepin's members. We are pleased to say that this investment was one of the reasons Wright-Hennepin received such widespread recognition in 2013 for its leadership in bringing renewable energy to its membership. Even with the slight loss compared to the previous year, Wright-Hennepin's members still benefited greatly from the diversified businesses because they reduced your retail price of power by almost $2 million in 2013 alone. Line 64, net operating and non-operating margins combined came to almost $2 million, very appropriate margins for a cooperative our size. Line 65, generation and transmission and other capital credits, comprised of allocations from our power suppliers and associated organizations, $3.1 million in 2013. These margins are only allocations, they are not cash received. Accounting rules require us to recognize them on our operating statement, as all cooperatives do. Line 66, net margins, our consolidated bottom line for 2013, $5,053,462, a very healthy margin, especially when considering you were provided with competitive rates, plus taking a number of one-time adjustments to continue providing you favorable rates into the future. Per the bylaws, margins from the electric operations are returned in the form of capital credits, which are credited on your electric bill at the end of each year. More than $39 million in capital credits have been returned to you since 1957. By any measurable standard, it is my opinion that your cooperative had an exceptional financial and operating year in 2013.